Welcome to MarketTamer.com. We're looking at an intraday chart from Tuesday, May 26th. We can see that the S&P 500 powered higher early in the day. Consumer confidence numbers came out. There was an Apple upgrade. Market continued higher throughout the day, and there was a slight pullback towards the end of the day, but in the last 15 minutes, an uptick kept the market near the high end of the range. And this movement was reflected and mirrored also in the NASDAQ. We can see it had a huge day, up 3.45% or 58 points to close at 1750. The Dow Jones also continued higher. It moved up 196 points or 2.37%. And the financials, they also had a pretty good day, up 3.26%. The semiconductor index was the index that yesterday we spoke about would likely have the greatest up move if the markets did continue higher, and in fact that's what we saw, 3.74% move higher in the semiconductor index. If we move to a broader picture looking at a 6-month chart, we can see the Dow Jones here, and we can see that yesterday was an absolutely pivotal day. This was the candle struck yesterday. We can see obviously the trend has been bullish, but that this day was especially important because of the last trading day, when we saw the 5-day just about to cross the 20-day. We saw the price action just hovering right around and just below the 20-day moving average. We had not seen a very convincing break of that moving average, but we were very skeptical that this rally was running out of steam. And the reason this level was so critical was because this 20-day has acted as such strong support throughout this rally higher. In fact, if we look back mid-March, late March, April, and mid-May, that 20-day held as support all the way up and has done so again. So there's no reason to bet against this rally at this point in time. That said, if you have bear calls in place, you may not be in a difficult position whatsoever. It's not really a trade to be concerned about. Why? Because bear calls often take advantage of stagnant moves, bearish moves, and even sometimes slightly bullish moves, provided the bear calls are out of the money. And it's only a very aggressive move higher that would cause a position to run into trouble. So what might be in place to give us some support and comfort here? Well, we can see the Bollinger Bands are closing in on the Dow here just above the current price level of 84.73. The 200-day moving average is also coming down here. We'll see that on the S&P 500, those two levels are actually intersecting here, so it's almost dual resistance right above the current price point. In fact, right around 934, we're seeing some pretty substantial resistance. We've seen that's also close to the past peak levels right around here. We could almost imagine a line being drawn right around the 930-ish area. So very substantial resistance. We need those levels to be broken through before we could argue that this rally will be sustained for any protracted period. If we move on and take a look at the NASDAQ, it is the only index that is essentially providing an indication that this rally could sustain itself for longer than we might expect, longer than the short term. And why is that? Well, we can see the 200-day moving average already has been breached. Yesterday's very powerful move broke above that. The move in the NASDAQ was certainly aided yesterday by Apple. We can see Apple had a very big up day based on an upgrade. It was up $8 or 6.76%. And no reason to bet against Apple, particularly in light of the high volume that was in place yesterday. That's a big signifier that the move could continue. And finally, we'll look at gold. Gold was the position we were least bullish on based on yesterday's video, and we can see yesterday it was down 39 cents. If you have any questions, we look forward to seeing you in class. We'll wish you the best.